Good morning, Professor. This is Amarjit. Today I'll discuss about the week 5 assignment, which is based on bond valuation. Before starting the assignment, I'll discuss about what is a bond. A bond is a document which is a contract in which one party agrees to pay a fixed rate of interest to another party over a certain period of time in exchange for purchasing the bonds. The bonds issuer usually a corporation or government pay interest to the owner. When the bond matures at the end of the period, the issuer repays the face value of the bond, called the par value, to the bond's owner. A payment received by the owner of the bond is referred to as coupon, and it remains fixed except as otherwise stated in the bond agreement. If a bond issuer cannot pay its interest or repay the bond's principal, then the issuer is in default. In this case, the bond's owner may have to take legal action to claim money it is owed. Basically, there are two types of bond. First one is fixed rate bond. Second one is floating rate bond. In a fixed rate bond, the payment remains steady over time. For example, if the bond pays 5% interest, then the owner will receive the payment each year, often in semi-annual installment. This interest payment will not change. In floating rate bond, the interest payment fluctuated based on some predetermined criteria, often the level of prevailing interest rate. In this example, in this question, we do have two types of bond, which is bond 1, bond A and bond B. The bond A has 30-year maturity, bond B has 5-year maturity. Both the bonds have same credit rating, same par value, same coupon rate. The time value of money principal indicate that the bond A, which carries a 30-year maturity time, is going to cost greater because its future cash flow have a higher percentage value. Although bond with a longer maturity time will trade at a higher price than bond with the same credit quality, coupon rate, and par value, longer bonds are more susceptible to change in interest rate. Now, we will discuss about which bond has the higher value, assuming par value, coupon rate, credit rating, and other variable remain equal. Bond A, which has 30 years of maturity, will trade at a higher price in the market than bond B, which has 5 years to maturity. This is due to the fact that ma- bonds future cash flow have a higher percent value the longer it takes to mature. According to the time value of money principle, there is an opportunity cost associated with not investing a dollar received in the future, which makes it worth less than a dollar received today. Because bond A's cash flow are further in the future, they will have a higher present value, which will raise the bond's price, which will raise the bond's price. And because the impact of interest rate fluctuation is compound over a longer period of time, bonds with longer maturity are more susceptible to functioning in interest rate. The main value of the money effect will cause the longer maturity bond to trade at a higher price when comparing bond with the same credit quality, open rate, and par value. Now we will discuss about the impact on market price of each bond if the interest rate in the economy grow up. Bond A has a longer maturity, meaning its cash flow are spread over a longer time. When interest rate increase, these future cash flow are discounted more heavily to their present value. This is because the longer the wait to receive the money, the greater the impact of higher interest rate on its present value. As a result, bond A's price will experience a more significant decline compared to bond B. Now we will discuss about bond B. Bond B has a shorter maturity, while its price will also decrease due to availability of higher yielding bonds. The impact of discounting future cash flow will be less pronounced because the cash flow are received sooner. Therefore, the price decline for bond B will, will be smaller compared to bond A, which bond would have higher percentage price change if the interest rate goes up. In increase, an increase in interest rate would result in a bigger percentage of price change for bond A. We demonstrated that rising interest rate result result in price of both bond go down. However, because bond A has a longer maturity, the percentage change will be more significant. There are some reasons behind that. First one is sensitivity to interest rate. In this case, duration is important. The duration of bond indicate how sensitive it is to fluctuation in the interest rate. Greater sensitivity is indicated by a longer duration. Now, greater duration equal to extended maturity. Bond A will have a longer duration compared to bond B due to its longer maturity. It is also means that the price of bond A will be more correspondingly impacted by a single point of difference in interest rate. Percentage change versus absolute change. Bond A will observe greater percentage change than bond B because of its starting price, which is projected to be considerably greater due to its longer maturity and higher income stream. However, both bonds may see a decrease in absolute dollar term. Now we will discuss about argument with a numerical example. We will we will have some assumptions like the face value or par value for both the bond is $1,000. For both bond, the coupon rate is 5%, resulting in a $50 per year interest payment. Presenting present interest rate on the market will be 4%. These all are our assumptions. Using the bond valuation formula, determine each bond's current price. The present value will be equal to coupon payment divided by 1 plus interest rate. Keep power will be the years. It will be year 1, year 2, plus and so on till our bond will not become mature. For bond A, which has a 30 years of maturity time, the present value of the 30 years coupon payment $50 and the $1,000 final face value repayment at the end of the 30 years would be added up, discounted at the current interest rate of 4%. The longer income stream would result in a much higher resulting price, PV, for bond A than $1,000. For bond B, 5 years. Similarly, figure out the present value of the bond of the 5,000 annual coupon payment and the 1,000 final face value repayment after 5 years, both discounted at 4%. Bond B's PV would be more in line with $1,000 because of its shorter maturity. Here is the conclusion. Due to the time value of money principal, bond with more time to maturity are traded at higher price. They are nevertheless more susceptible to change in interest rate. Both bond decrease in value when interest rate rise, but the impact on a longer term bond price is more severe. Bond with shorter maturity should make up a greater percentage of an investor's portfolio in order to reduce interest rate risk and preserve a steady income stream. This bond gives you more flexibility to reinvest your principal at higher yield and more liquidity. Thank you. That's all from my side. Thanks, Professor.